Hi everyone, and welcome to the Buffett and Beyond Stock Selection Strategies. And remember, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. And we will teach you how to construct your own portfolio through the use of our podcasts, our daily market letters, our weekly video stock analysis, and our proprietary computer program. Hi folks, this is your host, Dr. Joseph Belmonte, along with Debbie, and that's Debbie with a Y, and all the questions she has from our listeners out there in investment land. And before we get to our podcast today, if you want a free sample of all our materials, just go to our website, buffettandbeyond.com, and sign up for our 30-day free trial, which contains all of our information along with access to our computer program. And remember, it's free for 30 days. So yes, we will teach you how to invest like Warren, but you've got to figure out how to live like Jimmy all by yourself. And just before we get to our stock questions sent in or called in by your listeners, I want you to understand that we use a method of comparability called clean surplus. Clean surplus is an accounting and finance model that allows us to compare stock to each other regardless of their industry. And clean stands for comparable and surplus stands for profits. And clean surplus is the only, and folks, I repeat, the only researched and tested method of comparability that allows us to compare stocks in the exact same way that we compare the returns given to us by banks. And folks, it is this simple. If Bank A is giving us a return of 10%, while Bank B is giving us a return of 5%, then we would certainly invest in Bank A. Now, really, isn't that bank interest a return on equity? Yes, it is, and that's how we compare stocks. So the bottom line key to building a better than average performing portfolio is to select stocks that have clean surplus ROEs, return on equities, higher than the average stock in the S&P 500 index, which is the benchmark for the investing world. Now remember that over any 1 year period, 75% of mutual fund portfolio managers cannot outperform this index, and over any 10-year period, 96% of mutual fund portfolio managers cannot outperform the S&P 500 index. This means that just 4% of portfolio managers can outperform this index over time. And folks, the Buffett and Beyond method of stock selection puts us in that 4% category. The good.
Stocks that should be in our portfolio.
The bad.
Stocks that should be in somebody else's portfolio.
And the ugly.
Oh, stocks that should be in nobody's portfolio.
Okay, let's get on with some stocks. You'll see exactly how this method works and how we here at Buffett and Beyond set the investing parameters so that you, all of you, can outperform most of the professional money managers out there in investment land. And Debbie, what's our very first question of the day?
Well, hello, JB, and hello, everyone. This week we're going over the beverage industry with some of our favorites that we grew up with. And one that's doing very well, but that most folks have not heard of, and that's Constellation brands. But before we get into the Constellation, our first listener had emailed and wants to know the real thing.
Oh, no, not the real thing.
Well, they do. They want to know if Coca-Cola is still a good growth stock, and should he put it into his growth portfolio. He knows that Coke is the world's largest beverage company and markets over 500 non-alcoholic beverage brands through company-owned and independent bottlers and distributors. And John says the stock has not done much over the past year.
Yeah, and I don't think it's going to do much in the future either, and here's why. Now remember, we're looking at the clean surplus ROE, and think of your bank account. The bank account, S&P 500 or Dow 30, has a return on equity, and this is the clean surplus return on equity, of about 14%. Now, Coca-Cola has a clean surplus return on equity of about 13.8%, so it's close to the average stock. However, when we look at the retention rate, in other words, how much of the earnings is the company putting back into itself in order to grow, and that retention rate is only 26%. So if we multiply 26 times the 13.8% clean surplus ROE, we're getting about maybe a 4% growth. Now, the dividend is 3.4%, so you see where all the money is going. So in other words, Coca-Cola has a clean surplus return on equity, which means it should be growing about 13.8% per year. However, it's giving 3/4 of that amount back in the form of dividends and only 1/4 of what it's earning back into the stock in order to grow. So we just multiply the clean surplus ROE by the retention rate, and it looks like this stock is going to grow 3 or 4% per year, folks, which is not very, very much at all. And when we look at the revenue growth, it has been declining over the past 5 years. So if the revenue growth is not growing, then folks, this stock has a hard time growing if you're considering it for a growth portfolio. Figuring it for the dividend portfolio, well, with 3.4%, that's not bad. But don't forget, you will not get any growth out of the stock at all.
And the big question, Coke or Pepsi for the portfolio? Since Pepsi is a bit different than the Coca-Cola company, as 25% of sales and 45% of profits comes from the Frito-Lay company, it also owns Gatorade and Tropicana, and we all know that Gatorade's one of your favorite drinks, JB. Now the folks do too. Some of the folks are saying that they get into the snack end of the business. Was it a very good move for Pepsi? But how does the stock compare to Coca-Cola?
Well, when we look at Pepsi and we look at the clean surplus return on equity, and we see that it's 14.4%, which is about the average of the average stock. However, the retention rate is about 40%. So out of what it's earning, it's actually putting more back into the company in order to grow. So when we look at the retention rate and the clean surplus ROE, we multiply one times the other, and we see that Pepsi might have a 5% growth rate along with the dividend of 3.3%. So just looking at these numbers, we think that Pepsi will grow faster than Coca-Cola. However, Coca-Cola is not going to grow very fast, and we don't think Pepsi is going to grow very fast either. So when we look at these two stocks, we would not consider either one of these two stocks for a growth portfolio, even though they have nice dividends. But really, folks, the average stock is paying about 2.2% in dividends, and here you're getting a little bit more in dividends, but boy, you're getting no growth out of these companies whatsoever.
All right, JB. And the final question is on Constellation Brands, which is a leading international producer and marketer of beverage alcohol brands with a portfolio of wine, spirits, and imported beers. It acquired the Robert Mondavi Corporation in 2004 and the Svedka Vodka, say that 3 times, Svedka Vodka brand in
Beautiful,
2007.
very good,
It owns 30 production facilities, and 97% of all its sales are from North America.
Okay, now when we look at Constellation, and now Coke and Pepsi are not into alcohol beverages whatsoever, but Constellation is. As Debbie mentioned, they have vodka, they have wine, and all sorts of things. But now when we look at the clean surplus return on equity, we're looking at about a 20% ROE. Think of your bank account. A bank is paying 20% versus the average bank paying 14% interest rate per year, because we equate the return on equity with interest from a bank. Just to give you a comparison inside your own heads there. So, and we're going to go over these numbers comparison as soon as I finish with Constellation. But the clean surplus return on equity for Constellation Brands is about 20%, and the retention rate is about 70%. So not only is Constellation making about 50% more in revenues than either Pepsi or Coke, but it is putting more back into the company in order to grow. So that is a very, very important point. Now, when we break down these companies into numbers, we want to think of which company do we want to put into our portfolio. And since there's a big correlation between the clean surplus ROE and the return or the future return of a stock, we like to compare the ROE to a bank account. So we want to put our money in the bank account that's earning the most interest on our money. So when we look at Coca-Cola and Pepsi or the S&P 500 index, because we can buy the index in a mutual fund or through the spiders. And then when we look at Constellation, we want to look at these ROEs and say which one is giving us the highest return on our money. And Coca-Cola is the lowest with 13.8%. Pepsi is next with 14.4, so they're close. The S&P 500 of 14 and change, and then Constellation with 20% ROE. So just looking at these numbers, we would say we would rather have Constellation in our portfolio. So we would think that when we looked at the returns of these stocks over the past 5 years, Constellation would outperform the S&P 500, and the S&P would outperform Pepsi, and Pepsi would outperform Coca-Cola. So when we look at a chart of these stocks, and folks, if you want to see these charts, just go to our website and click on our podcast and click on iTunes and you'll see this chart. We can see that Constellation Brands is up over the past 5 years now. Constellation Brands is up 300%. The S&P is next at about 60%. Pepsi is next at about 40%, and Coca-Cola is up about 20%. So indeed, when we look at these numbers, we are pretty sure which stock is going to outperform the other stocks just by looking at that clean surplus ROE. Because in order to outperform the S&P 500, we want to put stocks in our portfolio that have a higher clean surplus ROE than the S&P 500 and a more consistent clean surplus return on equity than does the average stock in the S&P 500. And so when we look at this chart, we see that indeed, had we selected Constellation Brands 5 years ago, we would be up 300% versus the S&P of about 60%, versus Pepsi at about 40%, and Coke at about 20%. So yes, indeed, folks, you can look at that ROE, think of your bank account, which one is paying you more on your money, and that's the stock that you buy. And so remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. And right here at Buffett and Beyond Research, we will show you which stocks to put in your portfolio so that you too can outperform 96% of professional money managers over any 10-year period. Folks, we had a good week this week. You have a good weekend, and we will see you next time.